Okay, so what is emotional trading? Uh, so, inability to make clear decisions leading to FOMO traits, feeling trapped in negative positions while taking little to no profits, the attempt to snowball an option and go 100% in position, which will lead to further emotional trading, and then understanding that options trading, especially when emotional, can lead to exacerbated losses over time because of can lead to exacerbated losses over time because of that emotional trading and that inability to have that proper risk management uh, in play. So we have to talk about how to actually defeat emotional trading. And the only way to defeat emotional trading is by essentially having tools that give you a higher percentage of successful trades. So the first thing is actually understanding risk management. Risk management is essentially the concept that you have a bankroll and you don't want to throw it all away. Part of the game is essentially being able to play more, in a sense. The part of the game is being able to create more wealth over time and not just try to rocket into a millionaire position, even though everyone would like to do that. It's just highly, highly improbable, right? So you have to understand that. So part of risk management is also knowing when to take profits. Understanding that most money managers struggle to make, say, 5%, 10%, 20% a year, while in options, you are afforded to make that in one day, assuming you're not greedy. Okay? The next step is understanding and reading option flow. Option flow is simply put when you see big orders going into an option chain in one way or another, sweeps, blocks, multi sweeps, splits, whatever it is. Okay, and you tend to see this uh, quite often. And we have some tools that let you better track and see where the money goes. But it's not simply enough to know the trades. There's a lot behind the trades, and understanding why certain trades happen is equally as important as seeing it, right? Because seeing it is only half the battle. You could get into a losing trade because you might see someone else's attempt to make a trade, which is either a closing bet that you haven't seen, because there might be some other side to the trade, or whatever it is, but we'll go into that later. Uh, the next is blocks and charts. Simply put, blocks are uh, essentially uh, large volume, um, blocks of equity. Okay, um, but you don't want every large block. You'll see 250K block, 200K, 100K. You'll see a 50K block. You might see, 50,000 shares of, say, the SPY is obviously not the same thing as seeing 300,000 shares or 500,000 shares or a million shares. But there's more to it than that. A lot of times, blocks are actually late trades or late recorded trades, and understanding where the blocks are, because 9 out of 10 times those blocks are actually institutions trading, and it's very, very important to understand where institutions are trading. And then again, risk management concepts, taking profit. Not going to stress it. You got to understand. You got to take profit, or you will end up losing. So next step is, understanding your place in the market based on account size. For those with small accounts, sorry to say, you're probably not going to be able to make a lot of money at one time, and your want and need to make a lot of money at one time is actually going to actually exacerbate losses. So you have to understand that if you have a small account, you're going to have to go slow. You're going to have to, take either smaller positions until you understand, or you're going to have to make other things happen because you're going to have to build up your bankroll. You're going to have to take positions, based on percentage of your account size. This is why I say smaller accounts, you're going to have a lot of trouble trading within some of these markets. Okay. Uh, Next. Having clear-cut entry and exit criteria on a trade to follow is important. Understanding like you want to get in on this particular situation, you want to get in that particular situation. For instance, in most cases, uh, I'm gonna have to go ahead and say that most people try to trade breakouts, and while that does work, I like to take contrarian bets. Something goes down a lot, I sometimes like to see if I can pick it up for just a little bit of a bounce, and then consider if I want to follow the trend and follow that party. Next, understanding that when a trade goes against you, you have to make a decision to either exit fast or deal with the drawdown depending on the severity of the news, right? So when I say deal with the drawdown, in the options world, we see it all the time. Contracts go down 50%, and then they move back up. They go back down. They move back up. Recently, we've done a trade on Twitter, which the whole purpose of it was to wait for this initiation of a squeeze over the 33 handle. Right. Once we got that initiation over 33 handle, we entered a position in January 40s, and we held on to that position for about a month for our profits. Eventually, we walked away with about 80% to 100% on the trade in some cases, and that was great. But we just dealt with it. So how did you deal with these kind of risk management? Well, you have to understand that you're going to have to take positions and size them in stone. You can't just decide, well, I want to allocate a couple thousand here, a couple thousand there, a couple thousand there. No. If you're going to go in with a name, you have to understand what your level of commitment is to a name. What is your level of speculation? What is your level of confidence, right? If you're highly, highly confident in something, you're obviously going to put more money in something, right? But also, if you're highly, highly confident in something and you're going to put more money in something, you don't really need to make as much of a move on your contracts to get that same sort of bang for your buck. Now, the values I have set here, they're based on account position of $25,000, and these are kind of parameters I would follow uh, based on an account of $25,000, right? So, for instance, a trade that we took was VUZI, okay, and VUZI, I said, take one, two, three contracts for this particular strikes. I believe they were February strikes, and the idea behind it was we see this clear-cut pattern in VUZI where it goes to 5 and then goes to 8, then it goes back down to 5, then it goes back down to 8, and we just want to be a part of that move, but at the same time we don't want to have a lot of capital tied up in it, and we just want to trade that. Next. The idea is that you keep your positions and contracts open based on acceptable level of risk. I don't think anyone likes to be 100% in the market, especially in the swings that we see today. Being 100% in the market is probably not fun. It's a surefire way to get a heart attack, especially in options where you can see your options go worthless. So I like to, think that the most anyone has in any particular trade is maybe 10% of their account, 4% of their account, something like that, unless they really gotta do something, right? But that's what I'm seeing. So you have to understand your level of risk based on speculation and flow. Uh, based on speculation, right? And based on what we have to factor into the trade. So we're going to go into the flow and into the blocks next as part of this webinar. So essentially, this is kind of like my idea of what I chart and what I'm going on a position and what I deem an acceptable gain or loss for a position. Okay, and the reason why I think this way is because I understand that all it takes to make back the money that you would lose on a contract, assuming you follow proper risk management, is 1 to 2 good trades at a plus 50% range trade, which we see all the time, right? We saw those Amazon 1680 calls go from $5 to 10 I'm sorry, to $13 today before everything got smacked down, right? And we took profits. We took profits yesterday, so that was like an easy trade. We just saw the little up move, and we didn't want to get chopped up because we knew that FOMC was going to happen. We knew that no matter what the outcome was, there was absolutely no way our boy Powell was going to save the day today. So understanding that higher levels of speculation, lower levels of confidence, but you also understand that you essentially have a higher risk to reward ratio on a low confidence move because hey, I don't know if AMD is going to go to 11, but hey, it's worth $1,000 position, you know. And hey, it's working out for me. I'm already up 50% on it, right? I took those February 11 puts on AMD for 10 cents. I have, 100 of those contracts, and those things are up for me, right? And the reason why I did that is because, well, it was a high level of speculation. Is AMD going to 11? Probably not. Is AMD going down? Yes. Will I be able to make money on the time premium and on gamblers who want to bet on AMD going down to 10 or 11? Yes. And that's kind of what I did there. So understanding that a 1% position can go to a 2 or 4% position, just like my AMD is currently doing, is a very, very important thing to understand. But also, a 1% position can go to 0, and that doesn't really affect you emotionally, okay? So that's kind of important to understand. So the only way to really mitigate stress, obviously, is to mitigate, only way to mitigate stress, obviously, is to essentially mitigate your risk. And the only way to mitigate your risk is essentially take smaller positions, right? So the concept of a high confidence position and a high value position is obviously, it can make you a lot of money, right? We saw with Grub, we made 50% on the next day. We got out, we got back into the trade. We waited for a Grub squeeze to happen. Grub squeezed a little bit. We made again about 20-30% on the trade. It worked out for us, okay? And the reason why this worked out is because we did our due diligence on the trade. The chart was showing us the possibility of a squeeze. We challenged it. The squeeze didn't exactly happen, but the up move that usually happens before the squeeze occurred, and we were able to make money on that. So the next thing is understanding options flow. Now, options flow is huge. I cannot stress this enough. You want to know where big money is going. This is the meat and potatoes, right? This is what everyone wants to know, options flow. So everyone wants to know where the money is going. How do we find these high value trades? But more importantly, how do we know the high value trade is actually worth getting into? Because we don't know if a contract was bought or sold based on what we see on the flow. All we see on the flow, essentially, is that contracts have moved. Okay, we saw the volume traded, and yes, it went over the amount of open interest, which means that there is a difference in contracts whether it's been opened or closed. And that's what we're going to have to decipher and figure out whether contracts were opened or closed. In other words, sold to open or bought to open. And generally, as you'll see, as I'm going to show you, flow will give us an indication of where the market direction goes over time. I don't know if you remember, last time I did a little write-up on the flow, last time I did a webinar on the flow, we ended up having AMD go to, we had AMD at like 19, and we saw flow on AMD pointing us in the direction of 24, 25, and then we saw AMD go all the way to 32, right? And then after that, we saw AMD flow pointing us all the way in direction of 20, and we saw that flow. We didn't follow that flow, but we saw it. And that is a very, very powerful indicator of where the market can move, right? So linking flow to buyers and sellers is super important. And then we have to understand that sometimes buyers and sellers will see certain contracts flash, open, close, but our option flow is not really going to tell us that. Our option flow is just going to tell us that contracts have moved, okay? So reading the flow. Now you'll see on the website we have this little thing on top that says option flow. And then in option flow, you'll see these symbols, right? You'll be able to filter out these symbols. You'll be able to see when the contracts were traded, right? What the strike price was, what the bet size was. You'll be able to see it all, okay? And this is a clear-cut indication. I'm not going to say clear-cut, but being able to decipher this will be able to tell us whether or not AMD or Amazon or the SPY or XOP will move, okay? So on the 14th, we had bullish flow on SPY at strike price of 260, right? I'm gonna have to go back and check what happened, but this is just an idea of what's going on. AMD, we saw bearish flow open at reference price of 19.85, right? And that essentially told us that we were going to be bearish AMD. And that was when I started accumulating those February 11 puts, right? So we got to understand what all this means, and we have to read through the different types of alerts, right? What is a multi-sweep? What is a split? What is a block? And understanding what they mean for us, right? So blocks are single orders negotiated outside the markets, right? They need to be studied because we don't know if these plays were opened or closed. Okay, sweeps are buyers or sellers trading contracts above the ask and often direct to a more obvious open-close sentiment, right? But also, right, these will really screw around with the market because these are done on the open market and are usually done to move the contracts a certain way. Okay, split orders are usually blocks, but they're completed in more than one order to be sneaky about it. Okay, so if we learn about position sizing, obviously a higher value position is usually higher confidence, right? So less speculation. Okay, so we have to read through this and understand what's going on. So for instance, these bullish December 1700 strike Amazon sweeps at reference price of $15.99, right? I'm going to assume that might have been actually closed. I don't think that was open, right? So that's just something I'm going to assume. Okay. So next we have the SPY flow story. Okay. So essentially what we have here are some of the SPY prints that we saw on the 11th and 12th, right? And what we saw was all this bearish influx of SPY, right? Followed by some very small, as you'll see, 9K multi-sweep on SPY 293. That doesn't sound like a high confidence position, right? But that 255 SPY put, valuing at over $1 million in multiple sweeps, That's probably something we have to keep track of, right? So then the next day, we saw a mixed bag of stuff, right? We saw some more bullish and bearish SPY multi sweeps in the flow. And what this kind of told us was that essentially, while we did move up on SPY a little bit the day after, we're still overall bearish because people are still opening up a lot of puts, right? Um, there still are multi sweeps and puts, and this time they're at a higher strike price, which means that someone really wants to take it down. Meanwhile, the bullish calls are essentially at the money, which gives the buyer the ability to get out fast at a profit if it doesn't go his way, or get out fast if it does, right? So what happens is, if I look at this correctly, I would say those SPY 268 sweeps, the bullish ones, that's someone who literally opened it and then decided to close it, right? That's what it looks like to me. So, that's what that kind of tells me. It tells me that someone opened up some bullish calls and then closed them immediately. All right, so that's kind of bearish, right? So that's what the flow kind of told us. The flow told us that SPY was going to continue to be bearish. And since we understood that SPY was going to be bearish, we understood that SPY was going to continue to go down back from the strike price of 262. I mean, that's what we know, okay? So understanding that flow can give us a direction of the underlyings, and can give us where they can possibly go and where it won't go. And when I say where it won't go, like I said, if we tracked that one buyer of the 268s that looked like it was literally someone who opened and closed them, I mean, we probably know it's not really going to go to 268, right? And then reading through the concept of unusual volume, right? You have to understand where the move is going to happen, right? Because um, if we already exceeded an expected move for a week, you have to assume that volatility is going to rise, and it's going to be harder to profit on a trade. So this is the only way we're going to be able to give us an idea of where it's going to be likely to profit, right? And how. Okay, so this also gives us an idea of, hey, someone always knows. I mean, just telling by the SPY flow, you're going to tell me someone didn't know we were going to dump today? Someone already loaded themselves to the teeth in 268. I'm sorry, in 260 puts and 255 puts, and they're all in the money. Everyone's in the fucking money, you know. So that's just how that goes. So next tool we're going to talk about is the coded equity blocks. Finding where the institutions are trading the SPY and trading the NASDAQ, okay? So understanding that, first off, these coded blocks, they're usually reported late. You got to understand that. They're reported late. And since they're reported late, we cannot really take them at face value. We don't actually know if it's a buy or a sell. We don't know, okay? And then understanding which blocks are coded and not coded. And when I say coded and not coded, I mean there are certain volume codes. Institutions don't just trade random amount of volume. They don't just say, oh, we have 1 million shares, let's just offload them. We have 2 million shares, let's just offload them, or we need 5 million shares, let's just buy them. It doesn't work that way, okay? Usually, institutions have to buy, they buy in blocks. They buy slowly and sneakily until they get to their desired position. And that's generally what institutions do, because they cannot be bothered to actually cause a mass hysteria by either selling 5 million shares on the open market at one time, because where are the buyers for that? There are none, right? Don't exist. So if we don't know if something was a buy or sell, we have to essentially use it as a guide. Okay, we have to understand that the blocks will either tell us that they were a buy or sell a day after. They will be guides for us to understand where there are supports and resistances. Now, the blocks, okay? First off, not all volume is created equal, like I said. You think Joe Schmo's 5 shares is the same thing as Goldman Sachs's 500,000 shares? No. Okay, so SPY blocks are coded 5x and are coded at 501k and sometimes 510k, 511k, 512k, right? 501, 502, 503, right? QQ is coded usually at 401, 402, 403, 404, or sometimes 411, 412, 414, so on. Okay, so an idea of the SPY block is right there, and this is what the QQ blocks look like. Okay, essentially you can see when they came in, and on December 12th, right, we can see that SPY was 265, right? But we have blocks here at 265.48. We have blocks at 266.63, and we have a block in the morning at 268.22. Now, the interesting thing here is that every block is smaller than that early block, that 502 block at 268.22. Okay, so every block after that is at a lower price, which leads me to believe that they sold those shares, right? And they were continuing to sell those shares. Okay, so understanding that we don't know at first glance if they're buy or sells, but we can guess if they are going to be supports and resistances based on their share volume size, because a lot of traders actually use these as guides, and institutions put these out there for a reason, right? So we use that price action as a way of trading it as an indicator. 268.22 is essentially our line in the sand for us to be bullish. 268 under 268.22, we are going to be bearish. So price action, again, price action above prints are bullish, price action below prints are bearish. And then most of the time, the first blocks usually come around 11 o'clock. They're always late. They try to sneak them in, okay? That's just the way it is. And we always ignore blocks at 9:30 a.m. and 1600. Those are usually exchanges consolidating or reconciliating their books at the end of the day. So let's take a look at the SPY block story so we can get an idea of how the SPY blocks help us trade, okay? December 11th, okay, we have a lot of blocks at 264. Okay, the early blocks at 265, and then we trade blocks after that under 265, which leads us to believe that we're going to be bearish. Okay, we're going to be bearish. Where the quota blocks at 265 range and the other blocks at the 264 range keep showing us that we're going to go down. Okay, the next day, the December 12 blocks show us that 1268 block, but every block again after that one initial pump in the morning was lower, giving us an idea that we're still bearish, that we're not ready for an up move yet. It's just not ready yet. The market still needs to go lower. The market still needs to consolidate more. It needs more buyers. And when we get more buyers is have a fire sale. Make it cheaper for everyone to get in, right? Okay. So here's December 13th. Oh, lots and lots of blocks here, right? But every single one of them is still under 268.22. Every single one of those blocks is essentially under those 266 blocks. Every single one of those blocks is lower. Okay? If these prints keep coming in lower, obviously we have to go lower. Okay? Those are going to be the blocks that the financial institutions are trading. Okay? On December 15th, okay, we I'm missing December 13th, December 14th, but oh no, it's right there. Okay, so yeah, December 14th, yeah, 262. Hey, the blocks were right. There's a short there, right? I mean, it's not rocket science. That's what the blocks are telling us. As long as the blocks keep coming in under the previous prints, we're going to go lower. Okay. Now we fast forward to today's price action, and today we capitulated quite nicely, right? Notice I put an X at the 1600 time. That is essentially ignored because that is, again, financial institutions reconciliating their books. Okay, but we have 6 million shares at 251.25. Okay, this is going to end up being a big support resistance. Okay, otherwise, take a look. There are really no blocks. 1600. We had no volume today being traded by the institutions unless these are all late prints. Okay? So you have to understand that you're reading the blocks and not the price action, right? Because the blocks keep coming in lower, price action is going to go lower, and it doesn't matter what you actually want to happen. The blocks are going to tell us what is actually going to happen. Price action above blocks, bullish, normally. Price action below blocks, bearish. Okay? But to see where the big blocks are priced by institutions, to get a better understanding, right? Because we're not going to be able to simply trade blind. We cannot say, okay, the worst is over, we're going to go up from here, because, well, I don't know if we are, but once the blocks come in and once the institutions start telling us that, yes, they're buying more, well, that is when we are going to actually get in on a long. Until then, the roadmap that we currently see is continued shorts because blocks keep coming in under where we were, right? Blocks keep coming in under the previous blocks, and they're just making new supports and new resistances with those blocks. So until we start trading higher and above key blocks, one of the biggest key blocks I'm going to say is the 257 block right now, since we cannot get over that 257.88 block, which was the big gap block. That's going to be big. Until we get back over 257.88, you can't trust any up move. You have to sell every pump. So knowing this, you got to build a roadmap to the indices based on this price action. I cannot stress this enough, right? We, as normal retail traders, we're not going to be able to affect the underlying of a stock. As much as I would love to see the SPY just rocket all the way back to 300 and for us to go to SPX 3000, it's not going to happen. It's simply not going to happen, right? Not until institutional buying comes back in, and the only way to see institutional buying is through the blocks. So essentially, I hope I taught you not to go all in on a position. I hope you understand that it's best to mitigate risk and keep your emotional trading at bay in order to actually be able to make some significant gains on your portfolio. Unless you actually are able to, turn $100 into $1,000 every day, you're gonna have to essentially use proper risk management to trade, because otherwise you're going to be constantly emotionally trading and worrying about a few dollars exiting from your account when you should just be worried about making high quality plays uh, based on tools that you have at your disposal, like flow, like volume blocks. Okay, so I hope you understand that in this market environment, things are really not normal. Indices are making moves that normally take years to do, and they're doing it in days. Okay, if you take a look at the move that occurred from 2012 to 2018, I'm sorry, 2017, 2018, yeah, beginning 2018, that's kind of unreal, you know? And now you're seeing literally half of the time it took to create that move gone in one day. In one day, you've seen that happen. So, yeah, I hope you learned something here on this webinar. Sorry about the rocky start here. Was trying some new stuff, and you know, stuff happens. So I hope you enjoyed the webinar. I hope you learned something, and I hope that you can trade smarter by following the blocks, by understanding where things can go, and by following the big money. Because you know, this market environment, I understand things can be really, really tough. If anyone has any questions, we're here in the Discord, and we can and I'll answer any questions if you have them. So that's the webinar. I'm just going to do some quick charting here.
Discord?
Yep, Discord's up.
Okay.
So Grub has this squeeze thing that it wants to do, but right now it's very, very bearish.
Yep, see it.
And wow, I can't for some reason get a screen grab on Chrome. So this is the option flow tool. could look up IWM.
You know you're streaming this, right?
Yes.
Okay.
Gonna have to just cut this part out of the webinar and the blender at the beginning.
Okay.
December weeklies. $135. Baby,
Papa, where are you?
I'm downstairs. I'm doing the stream, baby.
And where is Pepe? I'm calling Pepe, and he don't come to me, and now I tell him he's in the bed.
Is he on top of your pillow?
No, he's actually using your clothes like blanket.
Okay. So I'm okay, baby. I love you. So everyone heard that on the stream. I love my baby. She found my doggy on the bed.
Okay, well, bye.
All right. All right. So I'm just looking up this IWM flow here, right? Because we have this 134 strike, 130. Look at this. Okay, so we have a put and a call, 135, and we have a 130 put, right? So let's check out this put. What's this put looking like, huh? Yeah, look at this. Look at this put. Oh yeah, it's ready. Buy signal, buy signal. There's a fucking major buy signal on the fucking option. That's funny. So yeah, um, Baba flow. What is this? 130 puts. Also 150K bet, right? Baba. Yeah, 130 puts. 1,400 of these guys traded. And that's this candle right here. That's when I believe it happened. Oh no, wait. Let's go to 15 minutes. Yeah, look right here. Boom. From literally from 10 cents to 30 cents, someone took these guys. 150K.
That's what's gonna happen with your AMD.
Well, AMD's already like they're already going for like 15, 16 cents, so I'm already up 50, 60%. Makes me wish I just put the whole account in that kind of position.
Yeah, I like to play. That was a good find, though. Quite honestly, really, really good. Very good cheap play.
All right, I guess I'm gonna shut off the stream. If anyone wants to join us in the Hush Trader Discord, we have our chat, and yeah, hope you learn something, and I hope you use risk management to your advantage. So yeah, have a good night and good luck, guys. The market should continue to capitulate. I'm thinking there was still no there was a lot of blocks today, so we're gonna have to see if we stay above 251. If we don't stay above 251, obviously we're gonna go down further. And yeah, have a great evening, guys.